call today. I'm Madhukar and I'm the CEO of MedPlus. I'll now request my colleague Prasad to make the necessary disclosure statement.
Thank you, sir. Please note that anything which we say that refers to our outlook for the future is a forward-looking statement, which must be read in conjunction with the risk that the company faces. A complete statement is included in our investor presentation dated May 31st, 2022.
Thank you, Prasad. I'd like to begin by thanking all of my 18,000 colleagues for their efforts and diligence that go into providing an essential service to our customers. As on 31st March, we catered to the healthcare and household needs of neighborhoods in 338 cities across 7 states and from 2,748 pharmacy stores in operation. Our last quarter performance, to go over that, our revenue was 9,659 million, and this has led to a gross margin of 2,059 million rupees with an operating EBITDA of 295 million rupees. Over 99% of our revenues come from our pharmacy operations. The pharmacy operating EBITDA was 397 million rupees. So at a pharmacy segment level, the operating EBITDA was 4.1% for this quarter versus 4.3% in the previous quarter. I'll now cover a few basic points on the full year performance for FY22. In FY22, we opened 747 stores, and this is double of what we opened in FY21. On the back of a strong Q1 and our rapid store opening program, we had 23.1% revenue growth over FY21. Our gross margin was 21.1%, and our stores greater than 12 months old had a store level EBITDA margin of 10.3% and a store level operating ROCE of 63.1%. In March, we launched our first full service diagnostic center and have received strong adoption from our existing and new customers. At this stage, we are still in pilot mode in Hyderabad. We will provide a detailed update on the pilot in Q2 FY23. As we proceed, our aim will be to leverage our existing store network and our existing customer base. With that, let me now continue with the update for Q4. On the network, we are continuing with a rapid store expansion program. As I mentioned, we have opened 747 stores in the last 12 months, with 288 stores being opened in Q4. This is the largest quarterly store openings in the company's history, and this comes on the back of our previous record of 183 in Q3. The highest additions were in Tamil Nadu and Maharashtra, 65 and 60 respectively. Going forward, MedPlus will continue to be aggressive on the store openings. Also, 50% of our store openings this quarter have been in Tier 2 and beyond, and this is proof of our cluster-based growth strategy. The maturity of our operations and supply chain allows us to grow and operate in these markets profitably. We now have 1,073 of our 2,748 stores in Tier 2 and beyond. In the last quarter, we had 17 store closures versus 32 store closures in Q3. So overall, we have had net additions of around 271 stores in Q4 versus 151 in Q3. And for the full year, the net additions of store have been 667 versus 306 for FY21. Now let me go over the age of the network and how it is important to us here. Overall, the store network is split into 27% being less than a year in age, 13% being in their second year of operations, and 60% in 2 years and older. So that means 40% of our stores have not yet reached their full growth potential, and they are under 2 years. To give you a sense of the impact of a rapid store expansion on the age of our network, we ended Q4 FY21 with just 30% of our stores being less than 2 years, while Q4 FY22, it's 40% of our stores are less than 2 years old. And this is on a much larger number, obviously. While in the sub-2-year bracket, our stores are still in their ramp-up phase, and so going forward, we expect these stores to contribute to our profits at MedPlus. On the store size, We closed Q4 with 2,748 stores with 1.61 million square foot, and last Q4 this was 2,081 stores with 1.2 million square foot. The average store size in Q4 was 588. To give you a sense of spread, we have 1,793 stores less than 600 square foot and 955 that are greater than 600 square foot. So our focus, as you can clearly see, is all about, opening as many stores as possible and making them as profitable as possible. So we have been talking about the whole, industry and our own, view of the market. As you all know, India is a large 150,000 crore market with very little in the organized side. And, even for a country of our size, even at this stage when we are the number 2 pharmacy chain out there, we're just around 50 stores. Compare that to a country like US and UK and all, US especially where you have got chains out there. In a country which is actually a third of our size or maybe even lesser, there are chains which are more than 7,000 and 8,000. So we believe, given the fact that the market is large and the penetration is extremely low, we feel it is extremely important for us to grow as rapidly as possible to establish ourselves across. And we also believe in growing profitably. If you actually look at it, in all this, we are growing in the states in which we already are fully established. We already have an established, supply chain network, warehouses and everything else. So we are just going out there and spreading the network even more. While we expect that we will continue to seed some new states going forward, the bulk of our expansion is going to come in these states. And the critical thing which we are looking at right now, and this is something which I'm sure will come up in the conversation as we go forward, is that there are, this is, I would say, a slightly more peculiar market than most markets out there, with a margin, the channel margin, which is kind of contained. It is 20 and 10%. That's not going to change. Even if it does change, it will change a little bit. So for us, given the fact that we have taken our position as the best value retailer in the pharmacy side, we pride ourselves on being able to give the best price, and we continue to do that at 20%. We believe a 20% discount on all bills above 1,000, there is no one out there who can match it, or on a regular basis, or at least who can beat it. But as you all know, there are new players in the market who are now giving some extra discount and all just to gain some market share. We know that there will be headwinds, and there are headwinds because of this. But the long-term plan for us is to, continue to grow the network, because we know that sooner or later everyone has to come back to the baseline, which is 20% or wherever it is at that time. So for us, the benefits of growing the network, while it may not increase the margin of the channel margin by too much, it will definitely help us gain efficiency both on the warehousing side, both on the corporate side, as well as increase the presence of the store, increase the overall acceptance of the brand, which will allow us to increase the private label, which is what will drive the profit. Of course, when I say that the channel margin is fixed, it is fixed to a certain level. I'm pretty sure that we can, given the size, we should be able to squeeze out a couple, 100 or 100 basis points, 100 or 150 basis points going forward. So that's been the thing for us, to try and grow this chain as much as possible. Now, moving back to the same store metrics, we measure this as stores that have been in operations, the same store performance. We measure this as stores that have been in operation for 12 months and more as on the last day of the reporting quarter. Revenue from these stores in Q4 was 8,239 million, and the growth was 7.8% year-on-year versus 4.2% for Q3. We continue to maintain a store-level EBITDA margin in the range of 10%. The store-level ROCE of these stores was 61% for us. Revenue mix. So for us, with scale, we're better poised to increase share of revenue from private label. Our private label range is intended to provide quality products at affordable prices. MedPlus today has over 850 curated SKUs across pharma and non-pharma. In Q4, 13% of our revenue came from our private label. This compares with 11.9% in Q3, and I have to point out that Q4 also had the impact of Omicron, But overall, the trajectory of increasing share of our private labels in our customers' basket continues. Our increasing presence in Tier 2 and beyond is reflecting in our revenue mix also. This quarter, 30% of our pharmacy revenues came from stores in these tiers. This is up from 26% in Q4 of last year. On the channel, on the internet and the online side, we continue to extend our coverage of PIN codes from where we take orders online, and this complements well with our stores. Going forward, we will increase the coverage of our 2-hour delivery offering. Store pickups as a share of online orders continue to maintain a higher share than home delivery, reflective of the convenience and accessibility of a store network. Overall, our online strategy is driven by our conviction that omnichannel is the more suitable and profitable approach in the pharmacy space. We have not spent heavily on customers online, and in fact, we find greater stickiness in those customers who interact with us omnichannel than those that interact with us purely via the online route. Moving on to our capital efficiency metrics. Our net working capital for Q4 was 63. This is a drop from 68 days in FY21. In Q4, the inventory in our warehouses was 38 days, and it is 39 days in our stores greater than 12 months. Because of the sales trajectory of new stores, their inventory turnover is lower in the first year. In Q4, the inventory level in our first year stores was 114 days. The store level operating ROCE for our stores greater than 12 months has been around the 60% level in recent quarters, and we look forward towards maintaining this level. Our operating cash flow for Q4 was negative 112 million on account of funding for working capital and capex for new stores. On our segmental data, I would like to add an important note. In page 18 of our earnings update, we have presented the business segments which are different from the regulatory filings. For example, opticals have been grouped under others in the presentation, whereas in the regulatory filings, opticals is grouped under retail. We hope this will be useful for you. So, situation going forward. As you all know, we operate in the very attractive pharmacy space, and we are poised for growth on the back of our store expansion. We have built a base over the last several years. We have warehouses, and we have a very strong network that allows us to open stores rapidly and increase our presence out there. We believe that pharmacy is one of those domains where omnichannel will always be there. People will look for convenience more than anything else. And the convenience of having a store in the neighborhood, convenience having a store that is easy to access and bring, easy to return products or to buy or get products delivered, is as important as the convenience of being able to operate online. So what we have seen from our experiences that customers go both ways. They are able to go online. When it suits them, they buy online, and when it suits them, they also go offline and basically interact with us. So we believe that the best way of actually getting to this market is to actually grow as big as possible, to be present everywhere, so that as the customer changes his habits and adopts the online method, he will, when he basically sees our store in the neighborhood, even if he has not experienced our service before, will basically look to, checking it out. As we all know, there are 2 or 3 players out there in the whole cab space. So let us say, between the Ola and Uber, neither of them, or one of them advertised heavily and the other never advertised at all. But given the fact that the network is already very huge, anyone who's been basically experiencing Ola or whatever, if he has a problem, will end up moving to the other service out there. Presence is already established, as long as the presence. So that's what we see ourselves as. Instead of trying and spending a lot of money in trying to change the habits of people and acquiring customers at this super expensive kind of rate, we'd rather set up stores and be present everywhere and be there profitably. So every store we set up costs around 30 lakh rupees. So I would see it as the equivalent of maybe acquiring around 3,000 odd customers. But this store which we set up actually ends up making us not just, acquiring some of those customers over a period of time free of cost, but also basically is a profitable thing for us to actually, grow. So, while, we are seeing a lot of, competition out there who are all trying to catch up and set up stores and gain, let us say, a customer base at extremely high cost. We don't really see the need to do that, honestly. We will continue to basically expand the network, and that'll be the theme for us. And one of the big things about that, as we continue to do that, will be, we become more accepted, we become more, people are more familiar with our brand, and they are more willing to try our private label and everything else that makes it more profitable for us. We continue to grow on the same base of costs, so hopefully that will also, drive the economies of scale to us. And meanwhile, also help us get slightly better prices for the customers and all, which will also improve our EBITDA as we go forward. So that will be the thing for us, growth through the cluster-based network, which allows us to build a brand that allows us to bring more private label basket out there, along with, bringing the other benefits of scale. With that, I would say that's the end of my update. I would now request the host to open the line for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amey Chalke from Haitong Securities. Please go ahead.
Hello. Thank you for taking my question. So I have two questions. First question is on the gross margins. So if you compare FY21 to 22, our private label sales contribution has gone up by around 2.5% or 2%. However, gross margins have been largely stable. So want to understand, is there a negative factor which is pulling these margins down? Also, if you can comment at the same time, how is the private label contribution outlook over next 1 or 2 years, considering we are growing exponentially on the tier 1 and beyond cities where the sales contribution could be on higher side, and also the outlook on the gross margin. Thank you.
Sure. So a couple of things here, and I will have to, come back with more data on this to you guys. Hopefully you can, come back and reach out to Prasad or someone from our team. One, the gross margin has actually not gone up as much as we wanted to, or as much as the private label actually shows out there, and that is mainly because in the previous quarter there were some COVID-related products, which would have definitely not been there in the quarter after that, and so those are not necessarily counted as private label, but those would still be high margin products. Absence of that would have, muted the margin a little bit. One. Second, the overall discount in the system has also gone up a little bit. So for us, what we will end up doing going forward is, try and get you data on the actual pharmacy and the other non-pharmacy kind of private label out there. April, May, last year, April, if you actually look at this thing out there, during the phase of COVID, we did not have any discount out there. And that resulted in a slightly higher margin, and hence, if you actually look at it, the margin looks slightly smaller here on the side.
Sure. And the outlook, sir?
Yeah, outlook, of course. See, as we go forward, we fully expect that the private label uptake in the smaller towns will be much higher, and we expect to grow the pharmacy side of the private label by 0.5% to 1% or even slightly higher every year. And the other part, of course, will grow much more significantly as the private label portion of our FMCG thing continues to be a great value, to the customers.
Sure. So second question I have on the rental cost. For this quarter, it has fallen sequentially from around, I guess, 30 crore plus to somewhere around 27, 28 crore. Considering we are adding more stores, etc., anybody would have expected to go up. So is there anything which we are missing or we expect it to normalize in coming quarters?
No, actually, over the last quarter, it has gone up, right?
If you compare from quarter 3 to quarter 4.
Yeah, quarter 3 to quarter 4, the rental expenses are 35.3 crores to 33.07 crores.
Okay. Sure. Then the other question I have is the home delivery to store pickup mix, which is moving in favor of home delivery. So going ahead, how do you see it will impact margins?
Not significantly, because we actually charge a 20 rupee fee to customers for home delivery, one. And we usually do it using our own drivers out there in a very small area. Our deliveries are under the 2-hour period, and they are from the 37 to 40 hubs which we have. And these guys are already costed for, and a lot of times we are able to batch these deliveries. So for us, even if there is a slight change, it's not going to be material for us. The 20 rupee will cover a portion of the cost of the delivery guy, and perhaps maybe on 1,000, given that our average bill size is around 1,800 on the home delivery on the online side. A further 20 rupees on the delivery will not, significantly change it.
Sure. Thank you, sir. I have more questions. I will come back in the queue. Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah. Hi. Good evening to all. Sir, one clarity on this other sub-segment which you talked about. So this quarter you have recorded about 5 crore revenue. Do you just want to give us a rough split of that? How much is opticals and what others are grouped in under this segment?
Okay. I'll just let my colleague answer this. The actual distribution of this.
It combines the wholesale distribution and the revenue from opticals.
How much will be opticals over there?
Opticals will be around 1 crore for this quarter.
That's helpful. Second question is on the pathology segment. So segmental assets, you spent about 80 crore already. Can you just give very rough, broad split of how this 80 crore has been spent so far?
No, you mean
segmental assets include right-of use assets. As per Ind AS, we have to create the right-of use asset on the leased properties, and the actual capex for the pathological division was around 32 crores this year.
And okay, that's helpful. But 32 crores, can you just talk about, let's say, roughly how much you spent in radiology versus pathology, or let's say how have you gone about spending this so far?
So this is money spent on the two, the one which we opened, the full service thing which we opened last quarter, and the one which opened in this quarter as of now. And the advances and all which we paid for 2 more centers which are coming up in Hyderabad. All of these have MRI, CT and everything else.
Just as a recap, sir, right now you have 2 labs which can offer both radiology and pathology service, and both have CT scan, MRI, and I don't know whether they have PET scan or not. Can you just update that?
They don't have PET scan. So CT, MRI, ultrasound, X-ray, BMD, and all the other machines which are, of much lesser cost out there. The, TMTs and all the other ECG, EEG, and MG-PFT and all. So we don't have PET anywhere else, anywhere in the company right now. The lab, there's one central processing lab in Hyderabad. For that, we have placed orders for the machines and all, and we have paid for it. So that's something which is coming up. So that's the pathology part. Otherwise, the pathology itself is a smaller portion of a diagnostic center where all you're doing is collecting samples. So that's not really, too much of a capex. Most of it is radiology as of now.
So just to get it right, in terms of network, you have a one central processing lab for pathology, and you have 2 labs right now. Both are in Hyderabad? Which are
Hyderabad, yeah. Both are in different parts of Hyderabad. Hyderabad is obviously a large city. And we will put 2 more at least in this city before we start, putting in labs in other cities. I have to stress this to you, Anubhav, that this is still under the pilot stage. We will come out with full details as we go forward. All I can tell you is that the initial adoption has been fantastic. We have a subscription-based, super disruptive kind of model, and we are finding great acceptance out there across the people in Hyderabad.
Okay, that's helpful. And just one clarity on this private labels. When you talk about 13% for this quarter or 12% for the previous quarter, this is for the network as a whole. What will be this percentage for stores which are more than year 2 plus stores?
Not too dissimilar, but I'm happy to get back to you with the actual number out there. We don't see it like that. But yeah, I think the percentage will be more or less same, but happy to get back to you on that.
Okay, thank you.
Thank you. The next question is from the line of Ashita Jain from Edelweiss Financial Services. Please go ahead.
Hi, good evening. So my question is on diagnostics only. So what is the expected investment that we're expecting in, say, next 2 years on pathology as well as in radiology in the coming 2 years?
I have to repeat my earlier answer, which is, we're still in a pilot mode here. I will come back to you with the full details, by next quarter at least, for sure. I can only repeat the same thing, which is great acceptance, but we have still not fully finalized the plan.
My second question is on the private labels. So of this 13%, what proportion would be from the pharma and what proportion would be from the FMCG side?
Typically 60% comes from pharma and the balance comes from surgical goods, devices and FMCG.
Okay, thank you. And just the last one, on your store guidance, how should we see it say in the next 2 to 3 years? How should we see the store additions happening in the next 2 to 3 years?
This year for sure we'll do more than 1,000. March we already closed with a run rate of, we ended March with over 100 net additions in March. So that means we are at a run rate which is exceeding 1,000 and we will get that number easily. I don't want to, give you any guidance on the years going forward, but all I can tell you is, you all know it's a large market. We're just scratching the surface here. As long as we can operate profitably and grow fast, why not? We'll probably grow faster going forward.
Thank you. That's all from my side.
Thank you. A reminder to all the participants, if you wish to ask any questions, please enter star and 1 on your touchtone telephone. The next question is from the line of Avnish Khara from VT Capital. Please go ahead.
Hello. My first question is on the formulary list in the pharmacy. So do you base the formulary list on the basis of the doctors in that area or is it based on the product margin?
No. I wish we could basically do it on the basis of what we want to do. Then we'd all had a 80% discount margin out there. No, this is strictly based on the demand in each local area. So every store which we set up, we have a good idea of what is being sold in that zip code. We start off with a forecast, and as we go forward, as the demand from the local area comes in through prescriptions and through inquiries and through online searches, we fine tune the product mix in that store. Not the product, the full range of SKUs in the store. So completely based on what the local doctor is writing out there.
Okay, sure. And my second question is on the franchisee model. So do you expect something like that to pick up for your future growth in the next 2 to 3 years? Or do you think that you are more comfortable only setting up your own stores?
No, on the franchisee stores, we have tried it several times for various reasons, but we have never really found any great success in it because it is such a price competitive market and the margins are low that there's really not enough for us to share between, let us say, the company and one independent entrepreneur. So we much prefer setting up the stores ourselves and running it.
All right. That's it from my side. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. The next question is from the line of Ankit Bansal from AP Private. Please go ahead.
Hello.
Yes, sir. Please proceed with your question.
Sir, my question is, the kind of model you are applying, I have one concern that, sir, you are operating multiple stores in the same location. Sir, one wrong behavior from one of your employee with the customer will deplete all the good work done by other stores. So don't you think this is a loophole in your model? I want to just know your comment on that.
No, I don't agree at all, because this is a operationally intensive business and this is also a logistics business out here. So it's easy to maintain stores in areas in which you already have management and supervisors out there and all. And in areas in which you're already known, it is much more easier to attract customers. I can tell you that when we started first in Hyderabad, it would take us much longer for people to recognize out to our stores. But today, when we open stores out in Hyderabad, 60-70% of our stores break even in 3 months.
Okay, so my next question is, sir, at the time of the IPO, you said in an interview, this is the starting, abhi to picture baki hai. Sir, can I bag on that comment?
Absolutely.
Hello. Okay. Thank you, sir. Thank you for your confidence.
Thank you. Participants, if you wish to ask any questions, please enter star and 1. As there are no further questions, we have one question from the line of Yusuf Gandhi from Topelson Capital. Please go ahead.
Hi. Thanks for taking my question. So I just wanted to take your view on the SSG that the business can deliver. The more than 12-month-old stores in the last 3 quarters have had low single-digit SSG. What is your experience in the past? I mean, I understand the base has a lot of one-offs and things like that. What would be a steady-state SSG that you would expect from your stores?
Okay, I have to give you a slightly longer answer to this out here. I know, all analysts love this whole SSG thing and all. The way we look at it is, when we set up a store, is that going to break even really quickly? Is it going to deliver the amount of EBITDA which we want from the store or not in the expected timelines, and does it meet the ROCE guidelines for us? So as long as stores get to, let's say, 60% of them are getting to break even in 3 months, 70% at 6 months, and then the overall, 10% EBITDA level is achieved in the second year, so from the second year onwards, and the overall network is at all stores above 12 months are at 10% above, we are fine. So we don't really stress as much about SSG for only one reason. When you set up a store out there in a neighborhood, you get a catchment, you get customers from customers from a reasonable, from some expected catchment. Over a period of time, what we have seen is cities in which we operate, most of them are growing really rapidly. They end up actually becoming more and more denser, and there then opens up an opportunity which we did not otherwise see in that very catchment towards the edge or periphery of that catchment. So when you go and set up a store there, they will end up taking some sales from our existing store out here. And for us, it is okay. As long as, 1 plus 1 actually becomes more as we go forward, we are still okay. As long as, on a combined level, both stores are profitable. The new store is getting to break even quickly. The new store is also getting to profitability. The old store is at 10% and above. We are perfectly okay with that. And because we know if we did not set up a store in a catchment which could take a store, we fully expect competition will take it. So given that ours is a business which not only relies on our brand being known for giving genuine medicines at a great price, it is also a business of convenience. So we are forced to basically set up stores out there to capture more of the market. So we'd rather do that. So given that, one, And given the fact that we have been growing faster than ever before in our history, we will see little bit of, split sales out there. That's one. But added to that, we're also seeing a lot of, headwinds out there in the market right now. Everyone is out there trying to capture market share by, passing on unviable discounts and everything else, and also on top of that, advertising heavily. So while we expect this will all continue for a while, we expect this will go on for a little while. As long as we are able to maintain our profitability and as long as we are able to maintain our growth and continue to maintain the metrics which we look for, we are fine. So the SSG which we delivered was around 7.3 or slightly more. We fully expect that, as long as the market continues to be like this, we'll probably be around that number only. But the goal for us would be to make sure that the network grows profitably, and our 1 year plus stores continue to be, delivering around in EBITDA in the range of around 10%.
Okay, fair enough. Sir, given the kind of store network layout that you are planning for next 1 year, we'll probably end up spending around 400 odd crores, and with diagnostic capex as well. So we might probably run out of the cash that we have in next probably 6 quarters. So should we see the balance sheet going forward? Would we open to raising more capital? Are we open to more maybe a tie-up or something with diagnostics players? Any roadmap there would be very helpful.
Sure. So a couple of things here. One, we raise money mainly for setting up stores, and we'll continue to do that. That's not going to, our opening or not opening of diagnostic centers is not going to come in the way of our opening stores. So we'll be well funded for opening the stores. If we decide to embark on a plan which requires additional capital for the diagnostic side, we'll figure out a way of raising additional money for that part, either through debt or equity or something else. But that's not going to compromise the growth of our stores, no matter what. So that will continue. Yes, we have cash in the bank. We also are accumulating cash, and we don't have any debt at all. So we can easily go and raise debt. So I really don't see the need for us to do anything extra to grow our stores. Diagnostics is another matter. Now, coming to diagnostic side, do we really want to go and tie up with someone else? Yes, we will be open to looking at all those things out there and all. But we believe that, as the world is moving towards a more kind of, one-stop shop kind of play, bringing the online doctor consult, the lab diagnostics and lab and home collection of lab samples and everything else, along with home delivery as well as available pharmacies, would be the way to go. Full-on OPD play is absolutely necessary for us as we go forward, and we'll figure out the best way of funding it, either through tie-ups or either through vendor financing or some other methods. But that's not going to impact the growth of our stores.
Okay, fair enough. Just one last question from my side. Are there any specific geographies or regions where we are planning to expand for the next 1 year? If you could highlight something on those lines.
We're going in the 7 states in which are already there. We'll continue to open stores both in the Tier 1 and Tier 2, Tier 3, Tier 4. More weight towards the Tier 2, Tier 3, and Tier 4 than Tier 1, I would say. But we are not ruling out the opening of a few stores in neighboring states out here, just to seed something out there, so that, when at some point, we would like that to, slowly take off and grow. So we possibly open a few in the neighboring states of possible Kerala or to maybe Chhattisgarh or Madhya Pradesh. But otherwise, majority of the growth is going to come from the states in which we are already present.
So Kerala, still the policy has not changed. I mean, if I'm not wrong, they didn't allow more than 1 store, right? So has that changed, and how do we?
It has changed. The government is now open. We have already talked to people out there. So there are changes now. So we could possibly go out there to Kerala.
Maybe. Is there any seasonality in our business in terms of quarters?
Little bit, during monsoons and during the rainy seasons and all, across the country and sometimes during the winters and all, there's bound to be more infection, there's bound to be more fevers due to cold and cough and everything else and all. But that apart, not much. I would say a little bit. It's definitely the effect of seasonality is a few percentage points here rather than the huge difference which you see in businesses like garments and everything else.
I have a few more. I'll come back in the queue, sir. Thanks a lot for taking my question.
Thank you. The next question is from the line of S. Mukherjee from Nomura. Please go ahead.
Yeah, hi, thanks. Sir, just one question on the geography mix, like you're going to, smaller cities, tier 2, tier 3 and below. How should we think about revenue per store or store level margins? How should, the mix and margin profile change as you go to less dense areas?
So definitely less dense areas or places which, buy medicines. Actually, I don't know if there's anything like less dense in India, but definitely places which have lesser buying capability end up actually buying a little less both in FMCG and in medicines also. So the top line would be slightly lesser. But the fact is, our brand in the states in which we are known is well known, and when we end up going to these small towns, especially with the additional listing of guaranteeing genuine medicines along with the best possible price out there in the market, we see a lot of people coming to us. So we do get a outsized share of the overall market out there in those small towns. Given that the costs are lower, both in terms of rent, manpower costs, and everything else, and given also that people here are more likely to buy private label drugs and all, and the product mix is slightly more favorable in a small town, we actually see that the margins in small town EBITDA margins are actually better than in the bigger cities. So while the top line may be slightly lesser, the overall margin is actually better, if not at least same, if not better.
Okay. And so one more question on your expansion. It seems like, at least in the near term, you would focus on the key, states, the 7 states that you're there. With the learning that you have, the infrastructure that you have, the back end that you have, when would you think about getting into some of the other bigger states, which you're not addressing today? Because I would assume the competition there would also not be very intense. So why is it that, you want to, essentially focus on these 7 states and not venture into new geographies?
No, for us, we see it as a business of logistics more than anything else, given the fact that our supply chain is fully set up. We are already supplying to several tier 2, tier 3, tier 4 towns in these states. It's much more easier for us to string along a set of shops along the same route than go and establish a completely new city and all that. Not that we are opposed to doing it, but given the capital, given the time frame, and given the fact that, we would like to grow profitably, I think we are better off actually going in the states in which we are there.
Fair point. And so in these 7 states, so you would be adding 1,000 plus stores, and that intensity would be there for how many years, you think? I mean, is there an assessment as to what is the number of stores that you can eventually set up in these 7 states? You have like 2,700 odd now. So when, at what point you think, you will be sort of saturating in these 7 states? Any assessment there?
So I can tell you this for sure. Much before we saturate here, we would have already seeded all the neighboring states, including places like Delhi and all, and we would have started our operations in those places and continue the good practices of this place into that place. So that is something which we will do. While we will not expand in those places, we would have seeded them and we would be ready to start. Now, on the question of saturation, it's slightly unlikely that we'll be able to do it anytime soon, mainly because we expect that the overall market in the country by 2025 is going to be 2 lakh crores. So if you take it as 2 lakh crores and if you take these states as having around 45% of the overall market, that's at least a 90,000 crore market out there. So for us, till we get to a 20-25% of the overall this thing, I don't think we'll be very happy. So if you're looking at a 20,000 crore, which is around 20-22% of the overall market in these places, you're still talking about at least 10,000 stores. So if you're talking about 1,500 stores per year or slightly more also, that's, easily another 5 or 6 years before, or at least another 4 years before they even, will get saturated.
Understood. Thank you.
And by the way, Sayan, actually, this is not just going to be, as we grow bigger and as the network goes bigger and bigger into the smaller towns, our growth is not going to be purely based on pharmacy only. It will also come from sale of FMCG, sale of private label, and sale and the morphing of the store into a convenience kind of store where people will end up buying a lot of other things. So slowly the mix will shift and we will have access to a larger market than just the pharmacy market. So in that sense, I'm not necessarily dependent on only the size of the pharma market.
Understood. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, thank you. Sir, some data points actually. Again, going back to diagnostic disclosure that you have in your presentation, where this quarter loss is about 7.6 crore. Just trying to get some clarity there. If you break up into two segments, the rent as well as the other costs, which is leading to this little higher loss of 7.6 crore. If you can break this up into some component, that will be helpful.
Sure. Actually, 4 crores of that went into marketing alone, into the brand ambassador, into all the other advertisements that you created. So, and the software and everything else which you developed for the entire, diagnostic side. So, a lot of it is capex and marketing out there for us. So, it's not all operating losses out there.
And how much will be the quarterly rent which will be coming in this?
Rent 63 lakhs for the rent for the whole thing for the quarter.
Okay, that's helpful. And secondly, again on the others segment where you have a 2.5 crore loss. So is this largely coming from the optical side? Because I'll be assuming that the wholesale segment should not be making a loss.
I'll let you call it. Yeah.
Opticals is almost at a break-even. The main losses coming in the other division was mainly in the distribution company, where we are passing all the margin to the pharmacy. All the expenses were sitting in that distribution segment.
So that's exactly my concern was. And then why are we showing it separately? Because this is effectively by clubbing it into others, we are not capturing the profit correctly, right?
Still having it third-party sales. That's why for the time being we kept there.
Okay, sure. And just coming on the normal business, this is like for the pharma drugs, which is about 74-75% of our revenues. What will be trade generics as a percentage of that segment, which is non-private label for you guys, but trade generics?
As of now, I don't think it is more than 1% to 1.5%. And we don't normally sell trade generics, but there are some trade generics which have become brands over a period of time. And so people ask for those, and we have to actually sell them. But I think it is under 1% is what I would think.
Okay. And roughly, very roughly, what's the average discount which you're giving on that pharma segment overall?
On the pharma segment?
Yes.
So across the board, I think the discount now sits at around 16% or 16.5%, because more than 60% of our sales come from 16%. 16.3% is the actual discount out here. You know that most of our sales comes from ticket sizes which are more than 1,000, and there we give a 20% discount. And that's the reason why it is high.
So what will be roughly average order value for us?
Average order value across, and I'm not talking only about pharma, is around 440 rupees is the actual thing.
Just trying, and this is where the doubt comes, is like, if our such a large portion is coming from orders which are more than 1,000, then would average order value come to 440? So how do we reconcile the two numbers?
So the bill size, the average order, as I said, is 440, right? What is the actual doubt out there for you?
See, if majority of our sales is coming from orders where bill size is more than 1,000 rupees, let's say even 60% is coming, that itself will be 600 rupees average order value, right?
So the number of bills on the lower side are actually much, much higher, and hence, that the average value tends to be slightly lower than 1,000 out there.
Just lastly on this clarity, the 16%, how this would have, let's say, a couple of quarters back, 2Q or 3Q, is that discount same or that has gone up?
The discount has been more or less same. Actually, it was, let me just read out from the thing out here. It was 16.6% last quarter. It was 16.6% to 17.1. Sorry, that's 16.6. Anubhav, can I get back to you on this question?
Absolutely. And sorry for this data-related questions. One last question to Hemant here. Other income, if you exclude the interest income, this is roughly about 5-6 crore per quarter. What are the just nature of this other incomes? Can you just give qualitatively some number, some idea?
Sure. Can we come back to you on this, Anubhav?
Yeah, sure. Thank you, guys.
Thank you. The next question is from the line of Harshal Patil from Sharekhan. Please go ahead.
Good evening, sir, and thanks for the opportunity. Well, sir, most of the questions have been answered. Just need a clarification, guess. I think I would have missed it. Sir, on the margins front, if I have to go ahead basically in 23 and 24, how is it that we should be looking around considering that you would be adding 1,000 odd stores? So any qualitative comment or directional comment around that?
Since we will continue to add stores and, obviously some of it will pull down the overall EBITDA a little bit, I would expect that, we would probably be seeing EBITDA in the same range going forward. But on the plus side, we continue to add, sales to our private label side. That will push the margin up. So unless there is any big difference in the market, I expect that the downward pull of the new stores will be compensated by the higher margins of private label as well as the maturing of the 40% of stores which are now under 2 years overall.
Okay. Got that. That was helpful. And so lastly, if you could just give me a capex number basically for 23 and 24, if at all you have the total capex including diagnostics as well.
Total capex for the entire year of 22?
Right. 23 and 22 and 23, yeah.
For 23, we'll have to come back.
Okay, sir. So that's it from myself, sir. Thank you.
Thank you. In the interest of time, that was the last question. I would now like to hand the conference over to Mr. Reddy for closing comments.
Thank you. I thank all participants on this call for your interest on the MedPlus journey. Our investor relations team can be contacted at ir@medplusindia.com for any questions out there. Thank you.
Thank you very much. On behalf of MedPlus Health Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.